This video will guide you through how VisionWorks, our next-generation life planning software, can take your financial planning business to the highest level.
So, thank you for your time. Today we're going to be talking about investment portfolios. With retirement and financial planning software, I'm going to suggest that investment portfolios do most of the heavy lifting in helping clients achieve their goals. But I don't think it's a solid foundation for a plan, simply because portfolio returns are the one tactic that's most outside of clients' direct control. And if you want clients to have confidence in their plan, I think you need to take a more balanced approach. So let's always remember the 3 C's: convert, create, and conserve. And what we need to be doing, I think, is applying a range of planning tactics in order to reduce the reliance on portfolio returns. So one of the examples that I like to use is clients who, if you do the financial attitudes work with them, have a very high work score. So that would include investment advisors, for instance. I think you can identify with this example, you're trying to build wealth through your business, not relying entirely, of course, on portfolios. And we have many clients who are in a similar situation. And yet I don't think that that's very often really considered. And I would suggest that it's because other planning software, it's challenging to increase people's income over time, other than based on some inflation factor. So I think that if we can include other things like, a career path for people, find out what their career would have to achieve for them to realize their goals, that we're including things that are within clients' direct control. So the bottom line is that portfolio returns are important, but I don't think they should be the primary tactic in helping clients achieve their goals. If you want clients to embrace their plans and attract referrals, I think you need to make sure your plans inspire belief and confidence. So including tactics that are within clients' direct control is certainly one way of doing that. So today, when we talk about portfolio returns, we're going to talk about the ability to change portfolio allocations over time. So I always talk about VisionWorks having a dynamic database, whereas other software has a static database. And the example I commonly use, of course, is changing vacation expenses over time, but it applies equally to portfolios. We'll also talk about the order of withdrawals, not from the point of view of tax optimization, taking money out of registered plans up to a certain tax level and then taking money from tax-free sources like a TFSA to supplement income. I want to talk more about the order of withdrawals from the point of view of estate planning, because I think, again, this is something that's not widely considered. I'm also going to introduce you to software called Portfolio Allocator, and I don't think it's something that people are very aware of. It was actually installed with your VisionWorks installation, and really nothing we talked about very much over the last number of years, simply because interest rates were so low that the allocation of interest-bearing instruments within registered accounts and capital gains instruments in non-registered accounts really wasn't a big factor. But with interest rates now having increased, I think it's something we need to revisit. So let's start by talking about changing portfolio allocations. And I just want to remind you that current holdings are intended to be the portfolio that clients have now. What I think I see often in reviewing plans is that advisors will put in the anticipated portfolio, the portfolio they want to change clients into, rather than the portfolio that clients have now. And I think it's important that you understand why we need to put in, the portfolio that somebody has now, and then on the allocation tab, change to that new portfolio. So again, keep in mind the ability to change entries over time, portfolios over time, is possible because of the dynamic database. So what we see is, and I'm using very simple portfolios today, but what we see is that they have a growth portfolio. And what I'm going to do is I'm going to change this to a balanced portfolio now. So I select 2023. So click once to select the year, click a second time to go into edit mode. And I'm going to change from that growth portfolio to a balanced portfolio. And then what I'm going to do is I'm going to go down and I'm going to change to a conservative portfolio in 2035. So again, click once to select the year, click a second time to go into edit mode, and now a conservative portfolio. By the way, they're in their 70s at 2035. I think Bill's 75 then. Now, what I want you to notice is if we look at that first portfolio, when we change the allocation, what we saw is that we had a 100% turnover rate in the holdings of the portfolio. And I think this is really important to recall. So if we put in the current portfolio and then we make a change on the allocation tab, that's where we're going to have this turnover rate and capital gains are being realized. We won't see that if you put in the preferred portfolio under current holdings. And I want to give you an example of how important this is. I had an advisor whose client had a very large non-registered portfolio and a very low ACB. So the advisor wanted to look at the portfolio and reallocate it, thought he could optimize it and so on, increase returns, reduce risk, etc. So he went ahead and he made the change, and he didn't at all get the result he wanted. As a matter of fact, instead of it being better off, the financial forecast was actually worse. So obviously, we got a phone call, what's going on? And what the advisor didn't realize was that the reallocation caused capital gains to be realized on the current portfolio, and the capital gains were significant. And the result was that because of those capital gains, the reduction in the value of the portfolio, that the new allocation, as much as it was, optimized, better returns, lower risk, it couldn't, given the time involved, it couldn't make up for this very significant capital gain. So it's really important to make that current to new portfolio change. The other thing I want you to be aware of is that as you're working with portfolios and maybe experimenting with different allocations at different stages of a client's life, if something doesn't work out the way you would like it to, all you need to do is click the revert button, and the portfolio allocations will reset to what they were before you made the change. So that makes things quite convenient. The other thing too that I would like to just talk about is the ability to have different allocations for different portfolios. So there's a joint non-reg portfolio, but if we go to Bill's tab, of course, we have the TFSA and the RRSP. And the reason I want to mention it is because you can get into circumstances, let's think about a year ago, when Federal Reserve officials proclaimed very clearly that they were going to be raising interest rates to fight inflation. And yet people stayed, fully invested. Whereas what we might do is we might consider moving the non-reg portfolio, because we might have to draw down on it at some point over the next few years. we might have considered moving the non-reg portfolio into something very conservative and leaving the TFSA and RSP and longer term growth assets. And then that way, if there's a decline in the market, clients aren't concerned or worried because they have a conservative, cash portfolio to tide them over in the shorter term. And it's one of the reasons that I think it's very important that we don't consolidate portfolios. In other words, all non-registered portfolios in one bucket, all TFSAs in one bucket, all RSPs in one bucket. I think separating them not only allows the client to say, yes, there are my 3 different TFSAs. This is all part of the foundation for belief in output, being able to model the client's circumstances quite accurately. But I think also if we consolidate holdings, then we start to lose flexibility around different allocations for different portfolios. And I want to now talk a little bit about weighted returns and risk tolerance. So I'm going to actually switch to a different allocation. One of the things that I think is very inappropriate, I don't know what other word to use, is to assume that clients are going to have the same allocation throughout their lives, based on some sort of risk tolerance assessment. As much as the regulatory authorities may think that, clients should do a risk tolerance and that should be how they're invested over life, I just don't think it makes any sense. Let's imagine the young doctor who has years ahead of them, who has a conservative return assessment, risk assessment, and wants to be invested in GICs. Well, that's the sure road to bankruptcy, so to speak. Returns being fully taxed, inflation eating away at the value of the portfolio, and so on. So I think it's really important that we talk in terms of portfolio allocations that can change over time, growth oriented when clients are young, more balanced as they approach retirement, more conservative in their retirement years. But that doesn't mean that plans can't reflect the client's risk tolerance. What we're talking about is a weighted risk tolerance. So I want to give you a little example of that. I've got a bill in a completely growth-oriented portfolio now for TFSAs and RSPs. And if we go down to reports, then what we'll see, and I'm going to come back and we'll talk more about reports later, because I want to talk about creating a separate investment policy statement. But if we come down to reports and have a look at the investment policy statement, I want you to notice that I have, I'm just going to select all portfolios for Bill. So this is a total of all portfolios. We're not going to break it out into individual portfolios. And when we produce the output, what you'll see is that all of his portfolios are consolidated, so total portfolio value for him, and also that there's a weighted total return. So this is the allocation across non-reg, TFSAs, RSPs, and so on. Just to paint the picture a little more clearly, Bill's 43, and I have him as a doctor. So I'm expecting him to make a lot more income in the next several years. So what we'll do is we'll go down and we'll take that allocation now. And what I'm going to do is go down to his 2040 when he'll be 60. And at that point, we're going to take some risk off the table. So we're going to switch from a growth-oriented portfolio to something that's more balanced. And then what we're going to do is we're going to go down to 2050. And we're going to change the portfolio to something that's very conservative. So he's 70 at that point. And I'm also going to apply this to his TFSA and RRSP. So all I have to do when I make the change to the TFSA is just click apply to all, and it will apply that same allocation to all of his portfolios. Now, my point in doing this is that you see that there's not an appreciable difference in the overall return. And when we go back and have a look at his weighted return, what you're going to see is that what was 5.04% is now 4.87%. So even though we have them growth oriented and then more balanced and so on, the weighted return hasn't really changed appreciably. So I think, again, it's important to understand that, you know, putting people in very conservative portfolios because that's their risk tolerance right now just makes no sense. We can talk about changing allocations over time, and as long as the weighted return weighted by the allocation and the number of years of that allocation, as long as the weighted return is within the client's, you know, risk tolerance, then I think we've met the regulatory requirements, so to speak, and I think we've been a lot more sensible in how portfolios should be allocated. I want to talk next about the order of withdrawals, and again, from the point of view of the estate output. So as I usually do, I have the cottage going to Bill Jr., which means that there's you know, an estate issue for Bill as far as capital gains are concerned and so on. If we have a look at the order of withdrawals, I want you to notice that I have funds coming out of the RRSP first. I'm saving the TFSA to last, but funds out of the RSP first and then the non-registered portfolio second. And if we go to the estate output, what you're going to see is that there's a negative residue of about $178,000. In other words, the amount of liquid assets that Bill has, given taxes on his death, the capital gains tax that's going to be paid on the cottage, it's going to Bill Jr., and the probate fees, that liquid assets less the charges to the estate indicate that the estate's underwater by about $178,000. What I'm going to do next is I'm going to switch to the portfolio or the withdrawals where I'm actually withdrawing from the non-reg first. We'll switch to make it this. I apologize. The non-reg first and the RRSP last. And the important thing, and we'll see this when we go back and have a look at the estate output, is that if we keep money in the RRSP as long as possible, withdrawing funds from the non-reg first, we're actually going to increase wealth because of the compounding effect in the RSP. If I just change this briefly so that the RSP is first, you can see the difference. We're taking money out of the RSP starting in Bill's late 60s. We're taking money out of the RSP first. So we see that there's a difference of about $70,000 because we lose the effect of compounding. So I'm going to move this down again so that we take money out of the non-reg first, keeping the money in the RSP, maximizing our wealth. But if we have a look at the estate output, what we see is that instead of the estate being $178,000 underwater, is $358,000 underwater because we used up our non-registered money, which is the liquid assets that we actually needed to pay the estate liabilities. So if we compare the two, we can see that in the first case, Sue's going to get less, gain roughly $70,000. The government essentially going to get the same. Bill Jr. is going to get the same, But just because of the order of withdrawals, we have a significant difference in the residue for distribution. So when we're talking about order of withdrawals, there's a preoccupation with, saving taxes. Let's take money out of RSPs first instead of leaving it all till later and having large taxes to pay on the withdrawals at the time. Forgetting the impact of compounding, but also we have to balance off what's more important to the client. If wealth creation is more important, keep the money in the RSP. But if the estate preservation, keeping the cottage in the family, reducing the impact on the estate, if that's more first, and keep money in the non-registered portfolio for estate purposes. So again, without the proper integration of wills, I don't think that this is being often properly considered. And I wanted to bring that to your attention. I'm going to switch over now to Portfolio Allocator. And again, this is a tool that we have had for quite some time, but I don't believe that it's being used. And basically what it says is, rather than having a balanced portfolio, let's say within the RRSP, we can talk about the allocation of assets across a range of portfolios. So what I'm going to do is I'm just going to switch to the current and reallocated portfolio that we were working with earlier. And I'm just, to make this easy, we can open up the different asset classes and talk about, the different portfolios. So I'm just going to make this 50%, long-term fixed and 50% equities, kind of a very simple balanced portfolio, just to give you an idea. So clearly what we want to think in terms of is having those fixed income securities within the non-registered portfolio, so they and the equities on the outside. So from a tax optimization point of view. So all we have to do is select the right plan, select the allocation that we want, click the calculate button, and then I apologize, I've got the wrong portfolio here. So let me just clear this. What I need to do is I need to select the portfolio that has Bill's non-reg portfolio, not the joint one. So let me go back and select that. There we go. So now I've got that allocation. And now when I click calculate, what we see is that the equity portion is within the non-reg portfolio, and the TFSAs and RSPs have all of the fixed income for reasons of overall tax optimization based on how we allocate assets amongst the different portfolios rather than within a single portfolio. So this is a very handy and very simple tool that you can use to do this. And you can even look at the allocation across portfolios that are within VisionWorks, CorpWorks, and TrustWorks. So you can look at multiple plans and portfolios. So the last thing I want to do is just go back to VisionWorks and talk for a moment about reports. I'm going to suggest to you that when you, and again, this is in keeping with the idea that plans should be balanced, that all the heavy lifting shouldn't be done just by the portfolio returns. So what I'm going to do here is I'm going to load an IPS, which is very basic. And what I mean by that is that in it, instead of, and I'm going to get rid of all of these, I'm going to have just the total, all portfolios for Bill, all portfolios for Sue, and all portfolios for joint. And I'll do the same for Bill Jr. So let me just resave that as my IPS. And the idea here is we don't want pages and pages of portfolio content within a report. We want a simple summary of what the portfolios have to do overall in their role within the plan. So we're going to just include the totals. And when we do, we end up with just a few pages. And we can see again the total value of the portfolio, the current and the proposed returns. We have the risk tolerance, standard deviation. We have the geographical output. And then for Sue, I haven't changed the portfolios, but we still have the total. And then we have the total for Bill Jr. So this is really light. This is just an overview summary. And the reason that I suggest this again is that there are other elements that could be included in the plan. Bill's career, downsizing a house, their spending plan. So we don't want to have portfolios appear to be everything in a plan. Now, what we can also do then is we can have a more extensive output, and we can actually create it as a separate IPS statement. So within the plan proper, we can have just the total all portfolios and then create a separate document that has all the portfolios individually broken out. And all we need to do is just select the IPS section, select all the content for it, save that as a full IPS, and then create that for clients as a separate document. So they can go through their plan, see the general portfolio requirement, and then be able to dive into something that's more specific. This introduction is a place where you can go in and edit text and do some overall explanation. You can also show the risk tolerance if you wish. And now you can see that we've got the total portfolio and overview summary. And then what we have are the individual portfolios. So we have the total portfolios that include VisionWorks, CorpWorks, and TrustWorks. And then we have Bill's non-registered portfolio, Bill's TFSA, Bill's RSP, Sue's total portfolio summary, anything that Sue has related to CorpWorks and TrustWorks as well. And then again, her non-reg, her TFSA, her RSP. So now we have a more extensive document, and we can go in, by the way, and add text for each of these different sections and talk about the different changes and so on. So again, without overweighting everything in the main plan proper, but just having portfolios as one part of a well-balanced plan. So those are the things that I wanted to cover today as far as investment portfolios were concerned. And as always, I thank you for your time.
Book a demo. We'd be happy to show you more of VisionWorks' incredible features.